Markets look calm today. Indexes are stable, volatility is muted, and price action feels controlled. For most participants, that calm is interpreted as reassurance, a signal that risks are contained and the system is functioning as intended. But historically, calm has often meant something very different. In complex financial systems, calm is rarely a sign that pressure is gone. More often, it is a sign that pressure is being absorbed quietly below the surface in places that don't show up in headlines or daily price charts. If markets were truly healthy, stress would be visible. Volatility would rise and fall naturally. Spreads would widen when risk increases, and pricing would continuously adjust to new information. Calm, by contrast, usually means volatility has been suppressed rather than resolved. It means price discovery has been delayed, not completed. And when price discovery is delayed for too long, the adjustment doesn't disappear. It accumulates. This creates a contradiction that many investors struggle to accept. Calm does not equal stability. In fact, some of the most severe financial disruptions of the past century did not begin with panic or chaos. They began during periods of confidence, low volatility, and broad belief that the system was under control. The danger lies not in visible stress, but in invisible compression. To understand why calm markets often precede instability, it helps to think in terms of systems rather than sentiment. Financial systems follow recurring patterns regardless of geography or ideology. When promises, leverage, or demand grow faster than the productive capacity that supports them, an imbalance forms. That imbalance can be managed for a time through policy, liquidity, and regulation, but it cannot be eliminated. It can only be postponed or redistributed. The first stage of this process is structural imbalance. Debt grows faster than income, consumption grows faster than production, or financial claims grow faster than physical supply. We are clearly in this stage today. Globally, total debt has reached levels that are historically extreme. Governments, corporations, and households all expanded leverage aggressively during years of low interest rates, and those obligations did not disappear when conditions changed. They remained on balance sheets. The second stage is stabilization. When the imbalance begins to strain the system, authorities respond by smoothing volatility. Liquidity facilities are expanded, regulatory rules are adjusted, and policy signals emphasize stability. Markets respond as expected. Volatility declines, spreads tighten, and prices appear orderly. This creates the impression that the imbalance has been solved, when in reality it has only been masked. The third stage is where calm becomes dangerous. Stress migrates beneath the surface into less visible channels. Instead of showing up in equity volatility, it appears in inventories, funding markets, derivative exposure, settlement systems, and balance sheet fragility. These areas are harder to monitor and harder to unwind. They function smoothly only as long as confidence remains intact. Eventually, the fourth stage arrives. At some point, physical, financial, or confidence limits are reached. Inventories run too low, funding becomes too tight, or trust breaks between counterparties. At that moment, pricing must adjust, often abruptly. When adjustment has been delayed for too long, it is rarely gentle. We can see elements of this pattern forming today. Debt servicing costs are rising rapidly as interest rates reset higher, even as total debt remains elevated. Global supply chains remain tight, with inventories across energy, industrial metals, and critical manufacturing inputs drawn down after years of efficiency-driven reductions. At the same time, global trade is fragmenting, geopolitical risk is increasing, and policy flexibility is narrowing. Despite these pressures, volatility remains subdued. That combination is historically unusual. It suggests that stress is being absorbed rather than released. The system is functioning, but with diminishing buffers. One of the most misunderstood aspects of financial stability is the role of policy. Policy can influence timing, distribution, and visibility of stress, but it cannot override structural limits. You cannot regulate your way out of arithmetic. You cannot legislate additional physical supply into existence. You cannot permanently suspend settlement risk. When obligations exceed capacity, adjustment becomes inevitable, regardless of intent. Another reason calm markets are misleading is that modern financial systems are global and interconnected. Stress rarely appears first where attention is focused. A disruption in one region often manifests somewhere else before it reaches headline markets. Tight physical supply in one country can create funding stress in another. Currency stability can hide trade imbalances until settlement pressure builds. Commodity shortages can remain invisible until delivery delays force repricing. Inventories play a critical role in this process. Inventories are buffers that allow systems to tolerate shocks. And when inventories are abundant, volatility can be absorbed. When inventories are depleted, even small disruptions can create large effects. Over the past decade, global inventories were deliberately reduced in the name of efficiency. That strategy works well in stable environments. It works very poorly when conditions shift. Calm markets during low inventory environments are not safe. They are exposed. Confidence is the final piece of the puzzle. Confidence allows systems to operate efficiently with minimal buffers. Funding rolls smoothly, counterparties perform, and settlement occurs without friction, but confidence is not resilience. It does not degrade gradually. When confidence breaks, it tends to break suddenly. That is why calm periods often persist right up until they don't. This brings us to the central insight. Risk does not announce itself loudly when it is building. It announces itself quietly. Calm is not proof that the system is healthy. It is often proof that adjustment has been deferred. And deferred adjustments in financial systems tend to be larger, not smaller. This does not mean collapse is imminent. It does not mean panic is justified. It means that the system is carrying more stress than current prices reflect. That gap matters, because when the adjustment finally occurs, it will be driven not by emotion or opinion, but by mathematics, supply and demand, and physical reality. In the next part, we will examine where that stress is concentrating right now, the specific pressure points that tend to fail first, and the warning signals that historically appear before calm gives way to repricing. If calm markets indicate that stress is being absorbed rather than released, the next logical question is where that stress is going. Financial systems do not eliminate pressure, they redirect it, and the most important pressure points are rarely the ones people watch most closely. Instead of equity indexes, stress tends to concentrate in funding channels, inventories, balance sheets, and settlement mechanisms, places where failure does not look dramatic at first, but can cascade quickly once thresholds are crossed. One of the most overlooked pressure points today is liquidity mismatch. Much of the global financial system relies on short-term funding to support long-term assets. This structure works as long as refinancing remains easy and confidence remains intact. But as interest rates rise and liquidity tightens, that mismatch becomes more costly to maintain. Borrowers face higher rollover risk, lenders become more selective, and balance sheets grow increasingly sensitive to small changes in funding conditions. Markets can appear calm while this sensitivity builds, because the stress has not yet been forced into prices. Another critical pressure point is inventories, particularly in commodities and industrial inputs. Inventories function as shock absorbers. When supply is disrupted or demand surges, inventories smooth the adjustment. When inventories are depleted, the system loses flexibility. Over the past decade, global inventories across energy, metals, and manufacturing inputs were deliberately reduced to improve efficiency and return on capital. That strategy lowered costs during stable periods, but it also removed redundancy. Today, many supply chains operate with minimal margin for error. Calm pricing in such an environment does not reflect resilience. It reflects vulnerability. Global flows further complicate the picture. Modern markets are tightly interconnected, and stress rarely respects borders. A shortage in one region can ripple through multiple systems before it becomes visible. For example, tight physical supply in Asia can lead to funding stress in European commodity markets, which then feeds into U.S. derivatives exposure. By the time stress reaches equity indexes, it has already passed through several layers of the system. Calm at the surface often coincides with strain underneath. Another area where risk accumulates quietly is derivatives. Derivatives are often described as risk management tools, but they also amplify dependence on continuous liquidity and counterparty performance. When markets are calm, derivative positions expand because volatility is low and hedging appears cheap. This creates a paradox. The quieter the market becomes, the larger the positions built on the assumption that it will remain quiet. When volatility eventually returns, the adjustment is not linear. It is nonlinear because positions must be unwound into a moving market. Policy plays a complex role in this process. Policymakers are not blind to these risks. They understand the fragility of highly leveraged systems and the importance of maintaining confidence. Their response, historically, has been to smooth volatility and delay adjustment. This can be effective in the short term. It buys time. It prevents disorderly outcomes, but it also has a side effect. By reducing visible stress, it encourages further risk-taking and deeper imbalances. The system becomes calmer on the surface and more fragile underneath. This is where many observers make a critical mistake. They assume that because policymakers are aware of risks, those risks are therefore controlled. Awareness does not equal control. Policy tools operate within constraints. They cannot create physical supply where it does not exist. They cannot permanently suppress the cost of capital without consequences. And they cannot eliminate the arithmetic of debt servicing indefinitely. Eventually, constraints assert themselves. A useful way to think about this is through the concept of capacity. Every system has limits. There's a limit to how much debt can be serviced at a given level of income. There's a limit to how much production can be increased without additional inputs. There's a limit to how much liquidity can be provided without affecting purchasing power. Calm markets often persist right up until those limits are approached. The closer the system gets to capacity, the less margin for error remains. One of the clearest signals that a system is approaching its limits is rising cost without visible stress. When borrowing costs rise but asset prices remain stable, it suggests that cash flow is being squeezed quietly. Households feel it through higher payments. Corporations feel it through reduced margins. Governments feel it through rising interest expense. None of this necessarily causes immediate market volatility, but it reduces resilience. It narrows the buffer that absorbs shocks. Another warning signal is the divergence between paper markets and physical reality. Paper claims can expand rapidly because they are not constrained by physical availability in the short term. Physical supply, by contrast, is constrained by geology, infrastructure, and time. When calm markets coexist with tight physical supply, the system becomes dependent on continuous confidence. As long as participants believe delivery will occur, prices remain stable. When that belief weakens, repricing can be sudden. This is why structural risk often emerges first in delivery delays, premiums, and settlement issues rather than headline prices. These signals do not attract widespread attention, but they matter. They indicate that the system is operating closer to its physical limits than prices suggest. Calm markets in this context are not a sign of balance. They are a sign that imbalance has not yet been forced into view. Another important aspect of calm markets is behavioral. Extended periods of stability change how participants perceive risk. When volatility is low for long enough, it is treated as a permanent condition rather than a temporary state. Risk models adjust, leverage increases, margins of safety shrink. The system becomes optimized for calm. This optimization makes it more efficient, but also more brittle. When conditions change, the adjustment is sharper because the system has lost redundancy. History shows that repricing rarely begins where most people expect it. It does not start with dramatic headlines or sudden crashes. It starts with small failures in overlooked areas. A funding market becomes less liquid. A commodity shipment is delayed. A counterparty demands more collateral. These events seem isolated at first, but they reveal that the system's assumptions no longer hold. Calm gives way not to panic immediately, but to uncertainty. And uncertainty spreads faster than fear. Now, this brings us to the question of timing. Calm markets do not tell us when repricing will occur. They tell us something else. They tell us that the system is relying heavily on confidence and that buffers are thin. Timing depends on triggers, and triggers are often external or unexpected. A policy shift, a geopolitical event, a supply disruption, or a sudden change in funding conditions can all serve as catalysts. The key point is that the system's reaction depends less on the trigger itself and more on how much stress has already accumulated. It is important to emphasize what this analysis is not. It is not a prediction of imminent collapse. It is not a call for panic or dramatic action. Financial systems can operate under stress for extended periods. They are adaptive. But adaptation has limits. Calm markets do not remove those limits. They obscure them. The most reliable way to think about risk in this environment is through arithmetic rather than emotion. Look at obligations versus capacity. Look at consumption versus production. Look at inventories versus demand. Look at leverage versus cash flow. These relationships determine outcomes over time. Sentiment, narratives, and policy responses influence the path, but not the destination. When calm markets persist alongside rising structural pressure, the eventual adjustment tends to be sharper because it has been deferred. This does not mean every calm period ends in crisis, but it does mean that calm is not a substitute for analysis. It is not evidence that risks are low. It is often evidence that risks are not being priced. The most important takeaway is this: financial systems do not reward complacency indefinitely. They reward alignment with reality. When prices drift away from underlying constraints, they eventually return. The longer the drift, the more forceful the correction tends to be. Calm markets today reflect a system that is still functioning, still confident, and still absorbing pressure. That should not be dismissed. But it should not be mistaken for resolution. Resolution requires imbalances to be addressed, not hidden. And addressing imbalances usually involves repricing. In the next analysis, we will look more closely at the specific indicators that tend to break first when calm gives way to adjustment. Not predictions, not timelines, but signals. The kinds of signals that appear quietly long before repricing becomes obvious, because by the time volatility returns to the headlines, the most important decisions have already been made by the system itself.